Will this cause the Fed to go bankrupt? Now, most people focus on the Federal Reserve and other central banks' influence on the markets. Since we're in a debt-based system, the more liquidity the Fed pumps into the system, the better assets, such as your stock, your retirement accounts, and your house and other risk assets will do. And with the Fed and other central banks switching gears to now monetary tightening, through QT and raising rates, we're seeing the opposite of that is also true, as stocks, bonds, and real estate are getting crushed. But most people don't stop and think about the impact it has on the Federal Reserve and other central banks. And that's a mistake because they're banks and they have constraints. So in this video, I'm going to break down the actual limitations and constraints the Fed has, what the number breakdowns are of these, how quickly this path towards QT will severely impact them, and show you why they're going to be forced to switch back to easing sooner than later. So let's go. All right, welcome back. We have a good one here today. Now look, we're always trying to figure out what is going to happen next, and some of the ways we can do that is by understanding the limitations and constraints that people have, and you'll know where that wall is and at what point they're going to have to turn around before they crash into the wall and die. That's what we're looking at for the central banks. All right, so the Fed and the market. So we're just going to start super high level, then we're going to dig super deep into it. The Fed and the market. So we've been working off of what's known as the Fed put for at least the last dozen years. So what does that mean? We know that the Federal Reserve, the central bank, is going to continue to pump in liquidity. And so we've had this long-term secular bull market. And we've had a couple little dips along the way, but these have all been buying opportunities because we've always known along the way that the Fed was going to continue to pump up the market. That is what the Fed put is. And they've been doing quantitative easing since 2008. They've been continuing to ease. They've tried a little bit of tightening, which would be reversing that, but mostly we've been easing. Now, you can listen to some people that are super smart, smarter than me, what I like to call academics, and they can tell you all the reasons why QE isn't inflationary. They can tell you that QE isn't inflationary because QE is only used at times when we have deflation. So it's not inflationary. We can say, well, QE doesn't actually go to the people, it only goes to the banks, and since it doesn't really get into the banking system, it doesn't really cause markets to get up. I get it. Look, I can have those conversations. I've had plenty of those conversations. But the reality is that it actually does. The reality is maybe it doesn't directly, but it does indirectly. And we have all the proof that we need. Here's the S&P 500 index. Here's the Federal Reserve balance sheet. Here's 2020. Here's 2020. As the Fed balance sheet has gone up, the S&P 500 has gone up. As the Fed balance sheet has started coming down, the S&P 500 has started coming down. So look, I get it. We can have these academic arguments, what I like to call factually correct, but intellectually dishonest. Because, like I said, there's direct and indirect things, but as you can see, it certainly have an impact. We can see right here as well, a glut of cash. This is important to set up the constraints of what the Federal Reserve has. And we can see that institutions have more cash than they know what to do with. So all these banks, they've been given all this quantitative easing, all this money. They have it at the banks. They haven't sent it out to the people. They haven't given it to you. What do with it? Well, they give it back to the Federal Reserve. They don't give it back. They park it there. They park their money, and because they park it there, not giving it back, but parking it there, they get interest on that. We're going to take a look at that, but you can see this little bump in 2020, barely recognizable, and look how fast this has grown to over $2 trillion right here. Now, just for another little quick look at it, we also have the Fed funds rate, which is the price of money. Most people don't understand this, but we actually buy money. We think that money buys us things, but we also buy money. For example, I want to buy a new house. The house is $500,000. I don't have $500,000, so I need to go buy the money. I have to buy the $500,000 to put down on the house. What's my cost to buy the $500,000? It's the interest rate. It's the price of money. The Fed funds sets the price of money, and of course that's what the Fed has been raising over and over. So we can see here, when Jerome Powell took office, he was ready to get the system back in check. He started raising the Fed funds rate very quickly. The stock market started crashing, and he had to reverse course and lower them back down again. Here we have this gray area represents the pandemic right here, and Fed funds rate have been basically zero, and now you can see just how crazy and fast they've been raising rates. I always like to show you the charts because I want you to see the speed these things have moved. So look, here's from January 2016, and here we have January 2019. So this is 3 years right here. This right here is like within a couple months. This is like 6 months. Look at the speed of those moves, and you can now see. Now, again, does this have anything to do with the markets? Well, let's take a look. During the same time, you can look at the S&P 500, that's completely blown up. Now, if we look at this chart, we can see this is January of 2022 is when they started raising rates, and on this chart right here, January of 2022 is when things started going back down again. So, I get it. We can have the academic debates, either do they actually do something, but indirectly or directly, it certainly caused that. Okay, now that we've set that up, let's dig in. What people don't understand, and one of the biggest misconceptions I think, is that the Fed is a bank. They're a bank, all right? And just like any other bank, it needs to pay its interest expenses. As I showed you on the chart, the banks have parked their funds back at the Fed. The Fed has to pay those interest expenses. That is the constraint that I think nobody is taking a look at. So let's calculate this interest. Let's look at the money. So the Fed earns an interest spread, right? So they have liabilities they have to pay out, and they have income coming in, right? Like a bank. So if we break these numbers down, as a matter of fact, I have it right here. It's probably hard to see, so I'll put the numbers on the sheet. But here we have in 2021, so obviously we haven't finished this year, we have a total interest income. The total amount of interest income the Fed received is $122 billion in interest income. I have it right here. 2021, $122.5 billion of interest income. But they had expenses, right? They have to pay. They have total interest expenses of $5.7 billion. Remember this number. We're going to come back to it. Okay, they had to pay out, they brought in 122, they had to pay out 5.7. They also had other expenses of 8.7 billion. You can see this here under operating expenses. They have total operating expenses of 8.7 billion. What are those? That's to pay for all their researchers and fancy PhDs and all those people that can't seem to find their way out of a paper bag. We'll come back to that. Okay, and then they sent, so the difference, the Fed, a lot of you maybe don't know this, but the Fed remittance that to the Treasury, so they sent 107 billion back to the Treasury. So they earned 122, they paid out 5.7 in interest expense, they had another 8.7 in expenses. The difference, 107, went back to the Treasury. So the Treasury now has income. That's great. It's great for them. So that's the way the math breaks down. I'm going to show you what happens next. Okay. So the interest rates are soaring, as I already showed you the charts. The Fed funds rate is going up at the fastest rate within 6 months we've gotten here. And if we look historically, the amount of money, the earnings on the interest have been historically good. So we can see, going back, let me pull this chart up. This is the Fed funds remittances to the Treasury. This is how much money the Fed earns and gives back to the Treasury each year, going back to 2012. 13, 14, 15, 16, all the way to 2021 right here. And you can see that we've been at about 100 billion, plus or minus, for the last decade, right? So it's been pretty good. Been a good year for the Fed, and it's been a good year for the Treasury because the Treasury is the beneficiary of all that money. But the problem is now, the Fed is raising the rates at the highest level yet. Now, what's wrong with raising rates? Well, there's good and there's bad, like anything you have to understand. So it's great for the Federal Reserve assets. Remember, they have assets and they have liabilities. So it's great for the assets because now they're earning more yield on that with higher rates. That's great. But it's also bad for the liabilities because now they have to pay more. So they're earning more on the assets, but they're paying more on the liabilities. Let's take a look at that. So again, I have this chart. You can see within 6 months just how fast that is versus 3 years over here. All right, now we can see that as the Fed funds rate have been raising, you can see this is the Treasury yields. This is how much they have to pay out on their liabilities. And look how fast the yields have increased. So here we have 0%, 0. This is 2022. And now here we are at 4%, 3.99, 4% within 9 months. All right. What does that mean, though? Most people don't understand. Let's break that down. Now, we talk about quantitative easing and we talk about quantitative tightening. So if they have assets, they're earning on that. If they tighten and start getting rid of those assets, they don't earn anymore. Right? Now, the Fed hasn't really been doing quantitative tightening as much as they say they have. That's a whole separate video. If you want a whole video on quantitative tightening, you can tell me in the comments below. Also, while you're at it, hit the thumbs up on this video just so the algorithm sends it out to more people, and don't forget to subscribe while you're at it. Okay, so how many rate hikes does it take to have quantitative tightening? Remember, if they tighten, if they get assets off their books, they're no longer receiving the income. Right now, we're looking at the Fed as a bank, okay? So the estimate is that a 2.2 trillion passive roll-off, so if they roll $2 trillion off their books, that would basically be like 29 basis points in the Fed funds rate, or 74 basis points during a turbulent period. Remember, they're going to have less income because they got rid of assets, and then they still have to pay the liabilities. So it's like increasing the rate on the liabilities. I know it's a little complicated. Let me break the math down for you here. I think this will help. So what we can see here is that every 100 basis points that the Fed raises rates, now if you've been paying attention, they've been raising at about 100 basis points. There's a debate right now, this next meeting, are they going to raise 75? Are they going to do another 100 basis points? We're going to use 100 for easy numbers. So for every 100 points they raise, it adds $85 billion onto their expenses. $85 billion gets added onto their expenses for every 100 basis points. So what does that mean? Let's break that math down. Okay. This is why you can't quantitative tighten for very long. Remember, we're in a debt-based system, so we can only grow through expanding debt. If we stop expanding debt, then the whole bubble collapses. All right, so every time the Fed has tried to taper or start to tighten, it's failed every single time. When they taper, they're getting rid of their interest income. So when they're letting those assets roll off their books, they no longer have income. And yes, banks need income. But at the same time, when they raise their interest expenses with the Fed, so they raise the rates, which makes their interest expense more expensive, and they've gotten rid of their assets, so they have no income. So they have less income and more expenses at the same time. It's not a good combo. We can see here in a chart, every time the Fed has tried to quantitative tighten, so this goes back, really QE started in 2008, so that's why you can see it right here. And you can see that the Fed right here tried to taper a little bit, and it barely kind of moved down, and they had to come off of it. They tried to taper again here, tried to taper again here, tried to taper again here, but they couldn't. They just had to keep pumping up. Finally, the market started rolling over. This is back to that chart where I showed you when Jerome Powell came in, all fired up, ready to make a difference. And then the market started crashing and they had to start pumping back up. Now you're going to notice that this, where they had to start easing, was well in advance of the March 2020 crash, which supposedly was because of the pandemic, but the central banks show us that actually it started in about September of 2019, not March of 2020. Then they were forced to blow this back up, and now again, supposedly, they're going to try to tighten this back down again. But the problem is, as I said, is that it's going to continue to add that expense. So if they want to quantitative tighten as they said they're going to do, it's going to add another $170 billion to the Fed's annual interest expense. You can see what we're talking about right here, $170 billion. So let's break this down for you. I want to show you the actual math here. All right, so yeah, ouch, it gets worse. So let's break down the math. At a 4% interest rate, which is about where we're at right now, the interest income, the amount of income the Fed brings in, is $122 billion. Now, I showed you when we looked at that breakdown before, they had, in 2021, they had actually had to pay out an expense. So they had income of 122, they paid out $5.7 billion, remember that. Now, the increased interest expense at 4%, goes up to 348 billion. So instead of 122, now it's going to be 348. Now remember, they still have expenses. They had this 8.7 billion that was in overhead and their economists and their PhDs. They have to pay this out, which means now the Fed will have a total loss at a 4% rate of 239 billion at this 4% Fed funds rate. They're going to lose 239 billion instead of having the 100 billion they've had for the last decade that they give to the Treasury every year. So instead of 100, instead of the Treasury getting 100, now they lose 239 billion. All right, now after earning, like I said, 100 billion for the last dozen years, the Fed is now primed to lose $240 billion. That's a swing of 343 billion, all because of this 4% interest rate hike. So how far can they continue to raise rates? I think that's the question that's on everybody's mind. And more importantly, how long can they leave those rates at that elevated level? So just wait, there's more. It gets worse. Now, like I said, as the Fed allows assets to roll off, they also have less income, right? This causes Treasury yields to rise, which we showed you this chart already. So as they're doing that, the Treasury yields are rising, meaning more expenses they have to pay. So they're losing billions of dollars, and they're also raising their debt servicing cost for the government. Remember, it's a double whammy at the same time. So is the Fed bluffing about what they're doing, or are their $8.7 billion they spend on their economists and their PhDs, are they just incompetent? Are they bluffing or are they incompetent? Either way, whether they're bluffing or they're incompetent, they're going to run into an actual wall, a real constraint. Let's look at that. So a few scenarios come to mind of what's being discussed by the Fed at their meeting. One, they're aware that raising rates this aggressively will bankrupt themselves, right? So if they keep raising rates, they're going to continue to lose money, as we've broken it down, and it's going to bankrupt themselves. So they're aware of that. They're going to bankrupt themselves, the U.S. government, and the world's businesses. So maybe they're aware of that. Two, they're trying to get markets to price in extreme hawkishness without actually doing anything. Remember, the Fed does things, the Fed intervenes in the markets both directly and indirectly. This is what I'm talking about, indirectly. Trying to get markets to price it in without actually doing anything. This would be the 4D chess move. Or maybe the third option, if they're bluffing or incompetent, is they have no idea. They have no idea. They're incompetent. They only watch PC inflation, which is lagging and manipulated, and their heads are just looking at the wrong data. So which one is it? Are they incompetent? Are they bluffing? Or they're willing to bankrupt themselves and the government? Well, let's take a look at this. So there is no way out of this, all right? Higher interest rates are going to continue to burn cash. Their expenses are going to continue to go up, and their income is going to continue to plummet. What they're going to do, because the Fed can't really go bankrupt, of course I said the title of the video, they're going to go bankrupt. They can't really go bankrupt because they have a money printer. So what they're going to have to do is they're going to be forced to monetize the debt with more printing. So at a time when we have inflation raging and they're trying to bring inflation down, they're putting themselves into a tough situation by raising rates. Their expenses go up, their income goes down. They can't go bankrupt, so they have to monetize that shortfall, which does what? Causes more inflation. The problem is they won't be able to tame inflation without going bankrupt, because if they keep raising rates, they're going to bankrupt themselves. So there's no way they can do that. The Fed cannot be austere. Austerity is living on a budget. Austerity is bringing your expenses down below the amount of income you make. The Fed can't do that. It's mathematically impossible for them to do this. As they're trying, you can see how quickly this situation is getting out of hand. The train, it has no brakes. It has no brakes. They have no choice. They're going to have to monetize this debt. The only question is, how fast does it happen? All right. Now, I've done a couple other videos showing you other math on why they're going to be forced to do this. If you want to check those out, you can do that. As always, give me a thumbs up on this video if you like it. If you don't, you can give me a thumbs down. That's okay. At least leave me a comment and let me know what you think. When will the Fed pivot? Go ahead, put your guess down below. Hit subscribe on this channel so you know when I put new videos out, and then watch these other videos I have on what the Fed's going to have to do. That's what I got for you today. To your success, I'm out.